That's a classic example of where you've retained a lot of control. I mean, you've retained complete control because you can revoke it at any time. So the IRS is saying that's not a meaningful transaction. However, it may surprise you to learn, though, that even when you create an irrevocable trust, meaning a trust that is a true conveyance in which there are rules that limit your access, if not deny your access completely to that money, that you can still have a trust that is included in what are called the grantor trust rules, and as a result is that the income continues to be taxable to you. And that those are always cases where the grantor, we'll assume it's you, where you've transferred assets and wanted to maintain some type of control. And there's even case law suggesting that if you have the ability to decide when money's going to be paid out at some time, if you have, even if you don't control who will ultimately receive it, let's assume you have 3 minor children and you want to control how that money's paid out, but yet you don't have the ability to pull it back to your own accounts or to your ownership at all under any circumstances, you still can be in violation of those grantor trust rules. In fact, when you look at the case law, that's some of the more interesting cases are ones where often fathers in the 20s and 30s decided to create these trusts for their wives and their children, and these men, as you might imagine, wanted to continue to have some element of control for reasons that we've discussed and many that you could conceive of yourself. These guys would write provisions into the trust where they could trade out a trustee, for example. They may have the absolute right to replace a trustee. They may be a co-trustee, but they don't have the absolute right of replacing the other trustee or trustees. They may simply have the ability to postpone the payment of money to their children under certain circumstances, but not to deny it completely. There are all sorts of gradations of control. If you could imagine a continuum, one in which there's a complete conveyance to an irrevocable trust and that's it, independent trustee, no participation by the transferor thereafter. That's on this end of the spectrum. Clearly that's a conveyance that has full income tax implications, not subject to the grantor trust rules. Then imagine the other end of this continuum in which you have complete control, and we know, and we'll use the revocable trust as that example. The point is there are not simply these two examples. There's a thousand gradations in between, and that's the nature of the law in the United States, is that we don't have a civil code, which is what's used primarily in Europe, and it's used in Louisiana to a great extent, where law is entirely the product of statutes, and statutes aspire to be as precise as possible. We have some of that in the United States, in some areas of the law where most of the law is entirely determined by statutes. But much of our law is from the English common law, and the English common law tradition was that they would develop concepts, and these concepts would be applied to factual settings. And so it becomes a source of continuing litigation to determine whether this factual setting is compatible with that precedent before it or not, or how you reconcile two precedents that seem to resemble the new fact pattern and determine which one applies. So the nature of the common law is that you do have a lot of continuing litigation and uncertainty about things such as this issue. So believe it or not, in estate planning, some of the case law is very interesting because it involves a lot of situations in which family members have attempted to sidestep often income tax liability, in addition gift and estate taxes, which we'll talk about in a few minutes. But they've had these very ingenious approaches to this problem. And many of them relate to these grantor trust rules. Is how can I give my money away so that I'm no longer taxed on it? Huge difference in tax rates. This is not a small matter. And at the same time, I want to retain control over it. And the reality is that the more you seek control, the more uncertainty there is about your goals with respect to tax planning. I won't talk more about that, but it's certainly something that will require some research as you talk about how you're going to structure it with your lawyer. There are certain forms that we know work. There are some easy patterns that you can establish that clearly will work and will be safely achieving your tax goals and yet have some small degree of participation. But that's an issue that we can revisit. Now let's talk about gift taxes. Most people don't think a lot about the idea that there is a gift tax because it may not apply to many of them. They may not think about it for a couple reasons. We have a $1 million lifetime credit for gifts. So that means that that up to $1 million in gifts, you will not be taxed based on any of those gifts. Now, when you try to determine whether that applies to you, you may ask, well, gee, how do you determine, whether a certain property that you've given away is $1 million property or not? And the general rule that the code provides for is that fair market value at the date of the gift is what's critical. So whatever would be considered a fair market value at the moment that you surrender dominion and control, that would be the value that's determined. And the case law on this issue too is interesting because you have the same problem. Maybe this is a theme that overarches the entire subject of estate planning is how do I keep control and at the same time surrender it in those ways that are helpful to me, and usually those relate to taxes. So the courts have had to struggle with what is the definition of a gift. And the case law has been very clear that there has to be a surrender of dominion and control, and then it becomes what's called a completed gift. So those terms are, as you might imagine, are pretty manipulable. And as a result, there is some uncertainty about their meaning. But on the other hand, you can, if you want to make a clear gift, you know how to do that. And that's simply you give up the asset and you don't attempt to retain control of it. So in that circumstance, it's the value on the date that you surrender your control. Now there is some good news, though, on this topic, in addition to the fact that you have $1 million lifetime credit. You don't even have to use that to the extent that you're giving away $12,000 a year per donee per year per spouse. So let me flesh that out a little bit for you. Let's assume that you're married and that you have 5 children, and you want to give away as much as you can this year to your children without paying any gift taxes and without biting into your $1 million lifetime credit. So how do you do that? Well, you and your wife would file a document with the court that would indicate that you'd file a document with the IRS which indicates that you're giving $24,000 to each child. That's called a split gift. You're each giving 12. So if you gave the maximum amount, that would be $24,000 times 5. Now you could do this every year, and that does not bite into your $1 million lifetime credit. And it's better than that because you can choose to give gifts which will have the most probability of appreciating. You want to get leverage in your gifts. The whole idea in these cases typically is to not simply give away money for present use, but often what's going on when you're gifting during your life is that really what you're trying to do is get these assets out of your estate. And the longer you're doing it in advance of your death, the better, because that means that if you choose your assets carefully, you can choose assets that would have appreciated a whole lot. You may know that. There may be interest in a privately held business. They may be real estate. It could be a variety of things that you have every reason to suspect will dramatically appreciate over the next 10, 20, 30 years. So when you're doing lifetime gifting, really what you're focusing on is how can I get the assets that will appreciate the most out of my estate. So that's the leveraging a gift. And then when you plug that in with this $12,000 per donee, per spouse, per year, you can see that over a number of years you can transfer a lot of money with no gift tax implications to your children. Now let's assume, or to anyone else. Now let's assume though that your concern is that you want to avoid income tax on these gifts thereafter as well. Well, we know how to do that. These are completed gifts. They have to be. They're gifts over which you no longer will have any control. But if you did this religiously and you did it for the balance of your life and your life extended for at least a decade and beyond, you can avoid in some cases all estate tax liability. And again, your estate tax liability hinges upon whether or not you have substantial assets. Most people in America, the vast majority of people in America, will pay no estate taxes. And as we've talked before, there's a $2 million exemption. So if you figure that with that $2 million exemption for you and a $2 million exemption for your wife, assuming you're married, that gets you $4 million through your estate with no taxation. But I realize that many of you who watch this show are people who do have assets. The overarching theme of Cash Counsel is executive asset protection. So I know that many of you will have assets in advance above this $4 million. And so you do have these concerns. But gifting during your lifetime is a wonderful technique to avoid a lot of estate taxes.